Hey everybody, welcome back to Layman Loans. In this video, we're going to see how you can take a loan against your insurance. So first of all, what is an insurance and what are the different types of insurances where you can apply for a loan? So there are different types of insurances. If you want to know what are the different types of insurances and what insurance is applicable for you all, you can follow us on Layman Insurance channel, and we have given an in-detail review about different sorts of insurances. But in this particular channel, we'll be talking about how you can take a loan against an insurance. Fundamentally, insurance is a long-term product. So there are different sorts of insurances. So there are insurances wherein if a person expires, their family or the nominee gets an amount. That's called as a term insurance. So any amount paid to a term insurance, you can never take a loan on that amount. All right. So it is just a premium what you're paying for the risk coverage what they are giving you, and there is no sum assured in that. If there is a sum assured in an endowment insurance, that is a kind of a long-term savings insurance vehicle. So those kind of insurance is what is actually eligible for a loan. Or there are insurances wherein something called as units linked insurance. So units linked insurance policy, it's called ULIP, wherein the amount what you pay, they give you a risk coverage as well as they'll invest the amount on specific mutual funds or stocks. So only in these two categories of insurances, wherein there's an endowment insurance where you are getting a sum assured after say 10 to 15 years or 20 years of time, can go even up to 30-35 years as well. So that sort of a sum assured insurance wherein you're getting a lump sum after a specific time, or an insurance wherein you are having a units linked, a mutual funds which have been purchased for the amount you're investing. So only in these two genre of insurances, you can actually apply for a loan. Second thing, when you're trying to take a loan, you cannot immediately take the entire value of the loan like after you start making payment on the first year. So assume you get a LIC G1 Anand policy and you pay the entire policy worth is about say 50 lakhs policy, and you need to make a monthly commitment of 15,000 rupees, and per annum you need to pay about 2 lakh rupees for another say 15 years or 20 years. So what happens, end of your maturity, so by about 30 years or 25 years or so, you will be getting a total lump sum of about 2.5 to 2.7 crores. But what you keep paying on a monthly basis or a yearly basis will be about 1.8 to 2 lakhs only. So assume you paid the first month 15,000 rupees. Are you eligible to take a loan against a 50 lakhs policy? Definitely not. And can you take a loan up to 50 lakhs by paying 15,000 first month? Definitely not. So what amount you can take a loan and when you can take the loan? That's what we're going to see today. Fundamentally, for you to be eligible to take a loan against an insurance, you should have paid the insurance policy premium for at least 3 years. So assume it's a 50 lakh policy and per annum you need to pay about 1.8 lakhs. Then 3 years consecutively you should be paying. So 1.8 into 3. So roughly about 2 years, it's about 3.6, 4.6 and 5.4. So about 5.4 lakhs in premium you should have paid in 3 years. And out of the amount what you have paid, they might, each company differs, they might allow you to take a loan of 50 to maximum 70% of the total value of what you paid only, because they are also giving you the risk coverage. If anything happens to you, your family is also getting the money, the entire lump sum amount as well. So this coverage is also given. So that is the reason they'll allow you to take a loan only after a period of 3 years. Most of the insurance companies, they have this cap of 3 years minimum in order to be eligible to take a loan. And once you take the loan, there will be an interest portion on this as well. So the interest can be as low as say 7 to 9%, or it can go as high as 17 to 19% as well. So depends on the company, depends on the product and how risk the product is. So if you're looking for a loan against ULIP policy, then you will get only 50% of the total value. So if it is going to be another product which is an endowment product, you can get even up to 70% loan as well. And these loans are either given directly by the insurance firm or sometimes it has been pledged as a security in say in the case of a prudential insurance or something like that, wherein you are trying to get a ULIP policy. They will not be able to give you any loan directly, but instead they'll ask you to pledge or hypothecate the overall ULIP policy to say Bajaj Finance or so, or any other NBFC like that, and they will be giving the amount, and until you pay back the loan, the policy will be hypothecated to them. So what do I mean by hypothecation? It will be technically in their name, and they have the rights to take the entire money, what you have paid so far, because they are giving you the loan. But in the case of like companies like LIC, they have their own system of lending money against a policy. So assume you have a Jeevan Anand policy and you paid about 5 lakhs or more against a policy, you can get 50 to 60% of the value as a loan. So if you paid about 5 lakhs, you can get up to 3 to 3.5 lakhs as loan against the amount what you have paid. And the interest rates will be pretty nominal, because this is a kind of secure loan what they are giving. But please do not forget to pay the interest, because if you don't keep paying the interest against this loan, and if you are not paying the premium for this insurance policy, there is a high possibility that the entire policy lapses and you will not be able to get any benefit out of the policy. So assume you paid 5 lakhs and you've taken a loan against this policy for 3 lakhs. And after that, you have failed to pay the interest, and you have also failed to pay any future insurance premiums. Then what happens is, after a point, after revival period, the entire insurance will be like completely going waste. There will be no surrender value, and literally you will not be able to encash anything. So literally for all the 5 lakhs what you have paid, what you get is the loan amount, the 3 lakhs, whatever you've got, that's all. The 2 lakhs will just, 2.4 lakhs will just go as unclaimed amount by the person. And there are like thousands and thousands of crores which are sitting in several insurance companies as unclaimed amounts itself. So please do not get to that state at all. So whenever you're trying to take a loan against insurance, do remember to pay the EMIs and interest in time, and always ensure the loans are closed within a finite period of time. These loans are usually not long-term loans. They'll give you a loan for a period of 2 to 3 years or maximum 5 years. So keep it as short as possible. Get it as like 1 or 2 years loan or a maximum 3 years loan, and try to close the loan within the period, and keep paying the interest whenever possible or at regular intervals of time, and always try to close this loan to ensure the policy is active, and every penny what you have invested in the policy you are able to get back with the due interest. I hope this video is useful for you all, and let us connect in the next one. If you're looking for an insurance assistance or how to get a loan against your insurance, please do connect with us in the link given in the description below. We'll be more than happy to help you out. Thank you so much for watching this video. Looking forward to connect with you all in the next one.